Okay, in this video from accounting101.org, we're going to do an introduction to the income statement. Now, the income statement is a financial report that deals with the company's revenues and expenses during a given time period. And basically, what the income statement is just a report of the revenues and expenses, and finally you get down at the bottom to net income. And so when people look at an income statement, what they want to know is, how did we arrive at this net income? What were our revenues, and what money or what amounts did we have to pay in expenses to generate this revenue, and what were we left over with? So the income statement usually covers a period, given time period, and that can be a month, a quarter, a year, or whatever time period the company produces the income statement for. Usually it's quarterly or a year. And so the first part of the income statement is revenues. Revenues are the fees that a company receives for its goods and services. So, for example, if ABC Company sells 100 widgets for $10 per widget, then their revenues are $1,000. That's the total amount of money that they have received. And it might not be, actually received based on accrual accounting, but we'll get into that in a later video. So, basically, it's the amount of money they've earned, whether they've received it or not. So 100 widgets at $10 a widget, their total revenues would be $1,000. Now, revenues are not income, and they're not profits. Revenues, like I said, are simply the total amount of fees that a company has earned from selling a product or a service. And the next part of the income statement is the expenses. The expenses are the costs that a company incurs to generate their revenues. Now, obviously, when an ABC company is selling their widgets, they had to produce those widgets, and so they had costs to make the widgets. They might have had raw materials like steel, iron, plastic, whatever the widget's made out of. Those are costs that they had. And then they might have to pay salespeople or advertising costs. And so on the income statement, you have your revenues, which would be the $1,000 in revenue, and ABC Company might have had $900 in expenses. And so if that was the case, it's a very simple example. That would leave ABC Company with $100 in net income. And so the net income, again, just means the amount of the revenues that are left over after you take away your expenses, or what it costs you, what it costs your company to produce and sell the widgets or your services. Now, there are more details, obviously, to a real income statement, but we'll explain those in a later video. Here's an example of an income statement. You'll see here, I have the title, which will be the company's name, that it's the income statement, that it's for the year ended, whatever. It could be for the month ended January 2010. It could be for the quarter ended, just whatever. It's for a period of time. It covers a period of time. And so at the top, you always have sales revenue. And in this example, it's $100,000. The costs of the goods sold, that's how much it costs you to produce the goods. So, if you were selling baseball bats, this would be the cost of the wood, and the cost that you incurred cutting the bats out of the blocks of wood and sanding them down, or whatever it takes to make a baseball bat. So if those were $60,000, your gross margin would be $40,000. The gross margin is the amount of revenues, or its gross income, that's left over after cost of goods sold. but you still have other expenses. So selling, general, and administrative expenses. If you're paying sales reps, commissions to sell your baseball bats, and then you've got an office, you've got office expenses to manage the salesmen and their paperwork and everything, and then you might have advertising costs, just all those other expenses. Those are right here. So then this is subtracted from the gross margin, so that leaves you with $30,000 in operating income or operating earnings. And then you have interest expense. That's $5,000, so that leaves you your earnings, your EBIT, or earnings before income tax, is $25,000. And then if you have to pay $10,000 in income taxes, then you would be left with a net income of $15,000. So that's how an income statement works, and this is what it looks like in really its most basic form. Like I said, we'll get into more complete examples in a later video.